Welcome to episode 7 of the MLO Exam Prep Podcast. In this episode, we'll break down the mortgage loan origination process, covering the loan application process, required documentation, underwriting and loan approval, closing and post-closing procedures. This is a critical topic for both your exam and real-world practice as an MLO. Let's get started. Mortgage loan origination, the big picture. What is mortgage loan origination? Loan origination refers to the entire process of securing a mortgage loan, from application to closing. It includes 1. Taking a loan application, 2. Collecting documentation, 3. Processing the file, 4. Underwriting the loan, 5. Approving and closing the loan. Key players in loan origination. Mortgage loan originator, MLO, assists borrowers with the loan application process. Processor gathers and verifies documentation. Underwriter reviews risk and determines loan approval. Loan closer prepares final documents for closing. Exam tip. A question may ask, what is the role of an underwriter in the loan origination process? The correct answer is to assess risk and determine loan approval. The Loan Application Form 1003. Definition: the Uniform Residential Loan Application, URLA, or Form 1003, is the standard loan application used for mortgage lending. Sections of the 1003 form. Section 1. Borrower information. Borrower's name, SSN, and contact details. Marital status and dependents. 2 years of residence history. Section 2. Financial information, assets and liabilities. Bank accounts, retirement funds, and real estate holdings. Outstanding debts, credit cards, auto loans, student loans. Debt-to-income DTI calculation. Section 3. Real estate information and property details. Property address and purpose, primary, secondary, investment, loan amount requested, occupancy status. Section 4. Employment and income. 2 years of employment history. Base income, bonuses, commissions, rental income. Section 5. Monthly housing expenses. Principal, interest, taxes, and insurance. HOA fees, if applicable. Section 6. Declarations and borrower acknowledgement, legal disclosures, lawsuits, foreclosures, bankruptcies. Borrower certification of accuracy. Exam tip. A test question may ask, which section of the 1003 form includes employment history? The correct answer is Section 4. Loan application requirements. What documents are required for a loan application? MLOs must collect documents to verify borrower eligibility, including proof of income, pay stubs, last 30 days, W-2s or tax returns, last 2 years. Self-employed borrowers, profit and loss statement, 1099s. Assets and liabilities, bank statements, last 2 months, retirement and investment accounts, credit documentation, credit report and credit score review, verification of outstanding debts. Property documentation, purchase contract for home buyers, appraisal report to determine home value. Exam tip. A question may ask, what document is used to verify a borrower's assets? The correct answer is bank statements. Closing thoughts on Part 1. Key takeaways. Loan origination is the process of applying for, processing, and closing a mortgage loan. The 1003 form, URLA, is the standard mortgage loan application. MLOs collect income, asset, liability, and credit documentation to process loans. Proper documentation ensures compliance and prevents fraud. In Part 2, we'll cover loan processing and verification steps, underwriting and loan conditions, fraud prevention in loan origination. Stay tuned. Welcome back to Episode 7 of the MLO Exam Prep Podcast. In Part 1, we covered the loan origination process, the 1003 loan application form, required documentation for loan applications. Now, in Part 2, we'll dive into loan processing and verification steps, the role of underwriting, fraud prevention in loan origination. Let's get started. Loan processing from application to underwriting. What happens during loan processing? Loan processing is the step where the loan file is verified and prepared for underwriting. Key tasks in loan processing. 1. Reviewing the loan application, 1-on-3 form, for completeness. 2. Verifying employment, income, assets, and debts. 3. Ordering a home appraisal to confirm the property's value. 4. Requesting the borrower's credit report. Checking title records to ensure the property has a clear title. 6. Assembling the final loan package for underwriting. Who performs loan processing? Loan processors work behind the scenes to ensure all documentation is complete and accurate before the file goes to underwriting. Exam tip. A test question may ask, what is a key responsibility of the loan processor? The correct answer is to verify documentation and prepare the loan file for underwriting. Underwriting, assessing risk, and making loan decisions. What is underwriting? Underwriting is the risk assessment process where an underwriter reviews a loan file to determine if the borrower meets the lender's guidelines. Key responsibilities of the underwriter. Review credit history and credit score. Analyze debt-to-income DTI ratio. Confirm employment and income stability. Ensure the borrower meets the loan program's requirements. Assess the loan-to-value LTV ratio based on the appraisal. Check for red flags that indicate possible fraud. Common loan approval conditions. If the underwriter identifies missing information or requires additional clarification, they may issue a conditional loan approval. Common conditions include additional pay stubs or tax returns, bank statements to verify funds for closing, letters of explanation for credit issues, proof of homeowner's insurance. Exam tip. A question may ask, what ratio is used by underwriters to measure a borrower's ability to repay a loan? The correct answer is the debt-to-income DTI ratio. Fraud prevention in loan origination. What is mortgage fraud? Mortgage fraud occurs when false or misleading information is used to obtain a mortgage loan. Types of mortgage fraud. Fraud for housing. Borrowers misrepresent information to qualify for a loan, e.g. inflating income, misrepresenting occupancy. Fraud for profit. Industry insiders, e.g. loan officers, appraisers, manipulate transactions for financial gain. Red flags for mortgage fraud. Income and employment red flags. Inconsistent or unverifiable employment history. Inflated income compared to industry norms. Recent large deposits without explanation. Credit and liability red flags. Sudden credit score increase before loan application. Undisclosed debt on the credit report. Frequent address changes. Property and appraisal red flags. Inflated property values. Undisclosed ownership interest in the property. Seller and buyer have the same last name but are not relatives. Preventing mortgage fraud. Verify all borrower-provided documentation. Require letters of explanation for discrepancies. Use fraud detection tools and third-party verification. Exam tip. A test question may ask, what is an example of fraud for housing? The correct answer is a borrower misrepresenting their income to qualify for a larger loan. Closing thoughts on Part 2. Key takeaways. Loan processing ensures all borrower documentation is complete before underwriting. Underwriters assess borrower risk using credit history, DTI, LTV, and other factors. Fraud prevention is essential to maintaining loan integrity and compliance. In Part 3, we'll cover loan approval and closing disclosure requirements, the closing process and final walkthrough. What happens after closing? Stay tuned.